Hello, I'm Christina Brooks-Olk, and I am going to be touching base on some of the various elements of current liabilities in a series of small recordings, so that way those that you need to refresh on, you can access those, and those that you need to not worry so much about, you can skip over those ones as necessary. We'll start at the beginning of the chapter and we'll work our way through the entire PowerPoint, but they will be in small, various lectures and recordings. So, Chapter 13 of Intermediate Accounting or Financial Accounting for Corporations 2, whichever section that you are in, is going to really focus on our current liabilities and contingencies. What are they? What makes them up? What are the things that create them? Uh, and then, how do we present this information to the users of the financial statements? What do they need to know, and how much information do we give them? As you're aware, transparency is always in favor, but sometimes there's just a point of too much information versus not enough information. So these are the various learning objectives we're going to look at. We're going to describe the nature, the valuation, and the reporting of various current liabilities. We're going to look at the classification issues of short-term debt that's expected to be refinanced. That will be in its own lecture series by itself. We'll eventually explain the accounting for gain and loss contingencies. That will also be in its own lecture series, and will indicate how to present and analyze the liabilities of the contingencies. Now, we talk about the presentation and the analysis of them throughout all of these. So just be aware that that one kind of rolls in and out depending upon which type of liability or contingency we are speaking of. So let's kind of just start with overall talking about current liabilities. This first one, generally, that's all we're going to discuss is just the real 5,000-foot overhead. What is a liability? So, FASB defined liabilities as the probable future sacrifice of economic benefits arising from present obligations of a particular entity to transfer assets or provide services to other entities in the future as a result of past transactions or events. That is a big mouthful of information to basically say that at some point in time, not today, this particular company or entity will have to provide either cash or services to another because of something that has already happened. So the underlying concept is here is that we have to determine the appropriate classification of the various financial instruments. Financial instruments being things such as accounts payable, mortgages payable, all of those different types of things that we have to pay out. And the companies need the proper definition of assets, liabilities, and equities. This allows us to represent on the balance sheet a truer, more transparent picture of the obligations of the organization. Often we use the conceptual framework definition as the basis for resolving any controversial classification issues. So, this is really just the starting point for us. When we are looking at things in accounting, sometimes it's not going to be exactly like something we have seen before. So we have to use our critical thinking skills and we have to say, okay, so does this fit into this mold? Or is there some element of it that completely goes against this? And if that is the case, now what do we do? Rarely is life black and white, and business certainly itself is not 100% black and white. It's those shades of gray that you need to develop the skills, critical thinking and otherwise, to tap information that you have learned about to allow you to come up with the best way to handle something. So, if you'll think back a couple months ago now, If you are in the regular series, current assets are cash or other assets that companies reasonably expect to convert into cash, sell, or to consume in the operations of the organization within a single operating cycle or within a year. Uh, Everybody kind of keeps that 1 year mark in their head, but do keep in mind that it is single operating cycle or a year. Flip side of that is your current obligations are those various obligations whose liquidation or payment or satisfaction is reasonably expected to require the use of resources that are currently existing and that are properly classified as current resources or the creation of other current liabilities. Most of the time, your current liabilities are not going to be satisfied by taking out some type of a long term liability or by some type of a fixed or long term asset. One of the things I'd really love you to stop and think about is the operating cycle. We talk about this in a variety of accounting classes, and we use the word operating cycle a lot. But again, like I said, everybody kind of keeps that 1 year mark in their head in between what is current and what is not considered current. But the operating cycle is also at play. And the operating cycle is that period of time between the acquisition of goods and services and the final cash realization resulting from the sales and subsequent collections. Now, let's really take a minute and stop and think about that for a second. So, the operating cycle is the point at which you purchase something, raw materials, to create a product. And then you have to go through the entire process of creating the product, selling the product, and realizing the cash from that sale. Now, in some industries, that could actually be significantly longer than a year. I want you to kind of just mull that over in your mind. In the live class, we'll talk about this more and look for some impacts, some discussions. So when you come to class, I want you to really think about some products and some manufacturing and situations where an operating cycle would be naturally greater than a year. So, just to wrap up this first little, very short, I know it's only been kind of a few minutes type of recording because we're going to take these in very small bits. Let's talk about what your typical current liability accounts are. Those are accounts payable, notes payable, the current maturities of your long term debt. So that's what you expect to pay in the next year operating cycle. Those short term obligations that you expect to be refinanced, dividends payable, customer advances and deposits, unearned revenues, sales tax payable, income tax payable, and employee related liabilities. Now, moving forward in this lecture series, I will take one or two of these at a time and we will discuss them. Uh, and I will do a lecture on just those particular sections. Keep in mind that when we look at uh, how we impact the different accounts of the accounting equation, that's assets equals uh, liabilities plus owner's equity, that to increase a liability, you credit it. To decrease it, you debit it. So as we are adding to it, that is going to be a credit in our journal entry. As we reduce it, we satisfy it, we pay it. We're going to debit it. Just again, a quick tip to keep in mind when you're sitting down and you're looking at a transaction and you're looking at a situation, because we give those to you in written format, you're not experiencing them. So sometimes you have a disassociation from it. Break it up. Sit down with a piece of paper, break it up into the things that you do know and the things that you do not know for sure. And if you have memorized how to impact the various types of accounts, what those accounts might be, then you are much farther ahead than you would be if you had to try to do it from top to bottom with nothing. So this will wrap up this first mini lecture. We will do accounts payable and notes payable in the next one. And I will have all of these linked to your Canvas from my YouTube by the end of uh, Tuesday following the initial week of class. Thank you.